In a world where financial solutions tend to be sliced into those designed for institutions and those for individuals, the large family offices and super high net worth families often grapple with the dilemma of which partners they work with and how, whether to do it predominantly themselves and access a variety of institutions for solutions, or to contemplate the idea of outsourcing the whole CIO function to one entity, or something in between. In today's Money Maze podcast conversation, we're going to explore how one of the world's most powerful financial institutions helps investors think about this challenge and why their approach has helped them become one of the largest family office specialists globally in over 25 markets, taking care of 50 billion of family office assets. So today I'm in the offices of BlackRock, and I'm looking forward to talking to Sheryl Needham, Managing Director, who heads their family offices for Europe, Middle East, Africa. Sheryl, welcome to the Money Maze podcast.
Thank you, Simon. Great to be here.
So before we dive into some of those thorny issues, you've been with BlackRock a long time. How did you find yourself in finance?
I've been at BlackRock for 20 years, and I found myself in finance actually in a really funny way when I think back at it. At school, I was quite generalist. So I was good at maths, I was good at English, I was good at art. And I was doing economics for my A-levels. And we were asked to do a project on a piece of news that was going on at that time. And actually, the big news piece that was going on was that Carol Galley of Mercury Asset Management at the time was involved and effectively had the casting vote on the Granada Forte takeover. So that is what I wrote my economics essay about that week. And my imagination was really caught by the idea of this woman wielding so much power in financial markets. Very unusual at that time. And her story also was very inspirational. She'd begun, I think, as a librarian and moved her way up in the organization. And really, my desire to go into finance came entirely from that. And interestingly, the only place that I wanted to work was Merrill Lynch Investment Managers, which is what Mercury Asset Management eventually became and what is BlackRock today. So I set my sights at 18 on being Carol Galley. I didn't quite make that, but that's the background.
Well, I had dinner with Carol the other night.
Oh, did you?
Who I know quite well. And I do some work with Stephen Zimmerman as well. So they are both inspirational. She is, and her brilliance is the questions that she asks that you hadn't thought about. So I feel suitably humbled every time I'm with her. So can you just explain how, having arrived at Merrill Lynch Investment Managers or Mercury, how your career has evolved within BlackRock to the stage that you are now?
It's very interesting because, as I say, 20 years at one firm is very unusual in financial services. But I've always felt that BlackRock as an organization has grown faster than my career ever could. So I originally joined as an intern and then a graduate in 2001 and spent the first 10 years of my career working in our UK wealth business. So covering family offices, but really mostly covering private banks, fund of funds, wealth managers, IFAs, initially in Scotland and the north of England. I think the reality was they were sending me as far away from head office to make my mistakes as possible, but eventually in London. And I covered every single client that we had and really had sold every product that we had across the platform at that time. In 2006, BlackRock bought Merrill Lynch Investment Managers. And in 2009, BlackRock bought BGI, Barclays Global Investors. So the end of 2009 was a very exciting time in the business. And it was a time where I'd done the 8 years and was feeling the need to spread my wings. I didn't really want to manage a team. I was loving the buzz of the sale. And I went to New York on business briefly and bumped into a mentor of mine in the office and was talking to him about my career. And he said, well, why don't you move to New York? This really hadn't occurred to me as an option, but the idea was incredibly exciting. And so I did various interviews, and there are lots of fun stories about those, but I ended up moving to the US in April 2010, I think it was. So I first joined our US wealth business, covering stockbrokers and financial advisors in various parts of the Midwest of America. I would say in hindsight, probably not the job best suited to me, wandering the high streets of Minneapolis, Wisconsin, Georgia, but a really amazing experience in understanding that wealth segment in the US better. I did that for around a year, and I think the firm joined me in agreeing that this wasn't perhaps the best role for me. And so I did what I really wanted to do all along, which was join our US family office business. It was an amazing opportunity. I was covering families in New York, in Florida, but actually most excitingly for me in Canada. We had no family office business in Canada at all. We had no relationships. We hadn't even tried to go there. I went on an adventure, lots of cold calls, lots of meeting new clients, lots of building relationships, lots of understanding of a culture that I wasn't really familiar with. I was a young single woman, and it was a really fun social time outside of work, as well as learning about this new market. And I got a call. Did I want to come back to EMEA to run alternatives coverage effectively for our wealth business? Now, that sounds like a big job. And today that is a really big job. But at that point, no one was doing it. And it was, do you want to come back and try and do this? And I had to make a decision about whether I was going to make my career covering Canadian family offices and stay in the US, or whether maybe this was the right moment to come back and reestablish myself in the UK, take all the learnings and the incredible network I built at BlackRock, as well as outside of BlackRock, bring it back to Europe and see how I could leverage that to have a broader impact across the organization. So I came back with a bit of a heavy heart. It certainly wasn't the exciting plane journey home that it had been on the way out to New York. But I began that job, and I started that job and did it for a few years, but quickly BlackRock formed a sales team called BlackRock Alternative Specialists. The decision was made that we were going to build our alternatives business and really focus on it. And today that business is $300 billion of AUM, so that certainly worked. So we were putting together this specialist sales team, and I moved into it. And my role turned into running hedge fund and liquid alternative sales across EMEA. Now, this was the first time that I had moved from being solely an individual producer into managing a team of any significant size. And it was at the same time that I'd been promoted to managing director. So it feels like a really pivotal moment in my career. And it was a complicated transition. I suddenly had a team of people who, in many respects, I'd considered to be my peers. And there are challenges around stepping up and managing people who you think are your peers and think that they are your peers. And so that took some time, and I learned a lot along the way. I was also managing a team across the whole of EMEA. I really had never had anyone report to me in different countries and different jurisdictions in the same way, and that was complicated. But at the same time, this was an incredibly exciting moment in our business. We were going to really focus on alts. Hedge funds actually were having a great time back in 2014. We had some fantastic products on our platform and we were really, really successful. And it was a brilliant 3 or 4 years. But I think, as you've heard from my career journey, 3 or 4 years went by and I quite wanted to try and do something else. It always seems to be that 3 or 4 years. And I remember at the time asking my manager, I won't name him, though I'm sure he wouldn't mind, asking my manager if he planned on maybe doing another job anytime soon, because I'd quite like his job. And he seemed very reluctant about the idea of moving on simply to fulfill my career aspirations. I suggested various jobs to him. Anyway, we laughed about it, but he wasn't going anywhere. And then the opportunity of running family offices came along. And it's very interesting. I had a sponsor and a mentor for years at the firm called Ken Wilson. He used to run Goldman Sachs with Hank Paulson and went to work in government at the time of financial crisis. An amazing man who was paired with me as my sponsor. And I think there was probably a little bit of trepidation around this at the firm because I'm quite loquacious, very irreverent personality. And Ken is amazing, but certainly comes across as quite buttoned up, conservative, old school New York investment banker. But Ken and I formed an incredible relationship. And Ken had been saying to me for years, Sheryl, you need to run the family office business in EMEA. It's been underinvested in. It's an opportunity which is enormous for us as an organization. And actually, you're the right person to do it. You're one of the only people that he could think of at that time who could spend 1 minute speaking to a Middle Eastern royal and the next meeting speaking to a UK billionaire and everything in between. And actually that sounded really exciting. I'd had this experience of focusing on a single product set and selling it to lots of different clients. But actually, I wanted to be able to do the thing which I think is most powerful at BlackRock, and to be able to deliver our entire platform to a certain type of client.
So you have the characteristics of irreverence and loquacity, which make you a perfect guest for a podcast. What I would like to do, though, is really understand how BlackRock, who are known essentially for their institutional expertise, have developed such a well-established practice. Just help me understand that.
So I think the best way to think about this is as follows. BlackRock don't have a private client business. We're not a private bank. Our distribution to high net worth, and actually even the vast majority of ultra high net worth individuals, is through our relationships with wealth distributors, so the big private banks. And that's how we access and meet that market. But there was a growing recognition, particularly in EMEA, that there are some families out there that are institutional in size as well as institutional in sophistication, and who actively sought out a direct relationship with BlackRock, and I'm sure with other asset managers, and didn't necessarily want to be intermediated by a wealth manager, by a private bank, by whoever it may be. And I think that is really a certain type of family. It requires them to have a structure in place. It requires there to be investment professionals working in the office. It's not the family that is working always through their private bankers. So it's a real subset of the market. Now, I can't remember the exact date of this, but I would probably place it around 2015. An exercise was done within the organization in EMEA, mostly in the UK actually at that time, to be honest, to try and identify how many family office relationships did we actually have. Because we did have family office clients. They were just being covered by the institutional sales team or the wealth sales team, wherever it was that they'd landed. And so this exercise was done, and effectively those family office relationships we had were pulled together to be covered by a single team. As I say, mostly focused in the UK at that time, but over time spreading into some of these EMEA relationships. But we found we actually had a decent book of business. Very interestingly, it was mostly invested in hedge funds. At that time, most of our alternatives business in EMEA probably was in hedge funds. And as I think we all know today, family offices have some of the highest allocations to alternatives of any client segment out there. So it was no surprise in retrospect that we'd found this load of hedge fund buyers who were families. And that's how the business began. Now, to go back to your question, there's a big difference between how do you find yourself in this business. You happen to have a load of family office clients who happen to have bought some BlackRock product along the way without any special effort or focus on our part. And how do you build a proposition to not only meet the needs of those clients, but actually to appeal to a larger set of families? And how then do you actually go about finding and meeting those families? Because as we all know, there's no list. And in many cases, the wealthier you are, the less you want to be found. So that required us to really start putting a strategy around prospecting and building a proposition.
So BlackRock has written, every great idea, every breakthrough started with a question. And I wonder what you think the question is that is most troubling your actual and potential clients.
So Simon, one of the reasons that I really love my job is that every family office is different. And so every family office has a different question. And our job is to find the answer to that question. Whether it's restructuring their private equity portfolio, whether it's helping them identify cost-efficient index building blocks. At BlackRock, we can really have that holistic consultative conversation. And I really view that to be a huge privilege.
So let's just drill down a bit, because I understand that you have typically two types of client. The client who comes to you in search of a solution, maybe a product solution, and we're going to talk more about those asset categories in a minute. And there are those for whom you potentially might offer the whole outsourced chief investment office function. So let's talk about each of those and how that relationship and that conversation develops.
Let's start with those families that are really looking for us to help them fill the building blocks of their portfolio. Let's call it that. So the type of family that has a full and sophisticated investment team in place. That investment team is responsible for the strategic asset allocation of the portfolio and setting a strategic asset allocation that will fulfill the outcomes that the principal and the family are looking for. So let's take stage one of their journey, which is that strategic asset allocation. So those types of families, we can help them think about their asset allocation. BlackRock obviously has an enormous number of people who are focused on asset allocation. They sit mostly within an organization here called the BlackRock Investment Institute, which we refer to as BII. So the BII uses cutting-edge technology and mathematics, really, to think about strategic and tactical asset allocation. And we actually have created several family office model portfolios with a huge caveat, as I said earlier, that no family office is the same. But we've created some portfolios to really meet the need of a typical, in inverted commas, family office, which here actually tends to be US dollar denominated, which some people find surprising, but US dollar denominated and this sort of capital preservation plus growth need that I mentioned earlier. So we can help with asset allocation. We can also help, and we do help, families looking at their existing portfolios and understanding the risks that are within them. It's very rare in this type of client scenario that someone comes to us with a bank account full of cash and a clean sheet. There's always legacy assets, but also legacy asset allocation and portfolio holdings.
Take the case of the family who give you a mandate for their entire pool of assets. I saw this in my career at Morgan Stanley, different though it was, that you have that tension between the in-house product and accessing external expertise. BlackRock has lots of great stuff, but it's not top quartile at everything. So just tell me how you approach that.
The way I would answer that question is, first of all, to talk about BlackRock's fiduciary responsibility. So unlike other business models, banks being an example, every single dollar of assets that we run is for our clients. So these trillions of dollars of assets that we have today, we have because we've been entrusted with them by our clients. It is an absolute pillar of the values and principles of the organization that we act at all times as a fiduciary to our clients. So to return to your specific question, a family comes to us, they want to work with us on a full outsourced CIO mandate. How do we ensure that we are acting as a fiduciary and providing them with a portfolio which is most likely to meet their investment outcomes? And you're absolutely right, Simon. There is, of course, a tension in these conversations around BlackRock product and third-party product. And we do both. We have a best-in-class third-party fund selection team. We also have two very large businesses within our alternatives business, our hedge fund solutions organization and our private equity partners organization that invest in third-party funds. So third-party is almost an intrinsic part of the business. The way this tends to pan out is that we give clients the option. So at one end of the scale, they can go from an all BlackRock portfolio. And quite honestly, many clients choose to do that. And I can talk about some of the reasons why in a moment. But I think the overarching reason is they've come to us as an active market participant and asset manager. And actually, they would like us to run their portfolio using BlackRock. The other end of the spectrum, I could say is an all third-party portfolio, but the reality is that those don't really exist. And the reason why is if you look at the breakdown of an OCIO portfolio or a multi-asset portfolio, and first of all, split it into liquid and illiquids. And let's focus on the liquid portion for a moment. At this point, the client with us has to make a decision about whether they wish to invest in index assets, in active assets, or in a combination of both. And we have many examples of those across the board. I don't think there's one overwhelming response to that question. When a client decides to use index, be it alone or in conjunction with active on their liquid portfolio, typically we would use BlackRock products. And that's because we are the biggest. I would argue that we are best in class in index and ETFs. And it seems illogical in many ways to think about going to a third party for something which we are so incredibly good at. When it comes to the active funds, as you pointed out correctly, we aren't first quartile in every single product, sadly. And so if a client decides they would like a combination of BlackRock and third party, or they would like just third party and active, then we're able to deliver that to them. So the tension, I think, in many ways exists when the client or we first raise this issue and have this conversation. But actually, it very quickly becomes, what's the best thing for your portfolio? And what is it that you're looking for? I would add in to this index and active conversation, some clients are much more cost aware and cost focused than others. So if you're looking to create a great portfolio, but optimizing for low cost, then you're much more likely to want to fill it with index and not necessarily to use active.
So just so I'm absolutely clear, can you sum up why somebody would come to you for that outsourced CIO function?
So the answer to that, Simon, is that we are a pure play fiduciary asset manager. And that means that our interests are aligned with our clients, and our interests aligned with the very simple question of what is the family office trying to achieve? Whether we use index, whether we use active, whether we use third party, or whether we use BlackRock product, we just want to deliver on our promises to that client.
So we'll move from the public markets to the private markets. BlackRock clearly has got a fabulous reputation in that space, and it's a complex area. And so we've got obviously several strands, but maybe start at the private equity end of things. Just talk to me a little bit about how you approach private equity.
So we approach private equity in two different ways. The first one through our private equity partners business, $38 billion of AUM, founded originally back in the Mercury days. And effectively that organization began as a private equity fund of funds. That's what it was. Running fund of funds for Merrill Lynch private clients at that time, but also running fund of funds for some large institutional pools of capital. It has significantly evolved over the years and has several offerings today that we approach private equity through. The first being the primaries module, let's call it that. So we invest in hundreds, if not thousands of primary funds. We are an LP to all of these GPs across multiple vintages through that traditional fund of fund model. And we can offer that expertise and due diligence and fund selection to our clients. So GP access through whatever way, shape or form that takes is option one. Option two, which was really built off of our GP offering, is co-invest. So we found that over time, there were GPs that we invested in who were making a particular private equity investment, which perhaps was a little larger than the capital that they had to deploy. And they would much rather go to their big client for that extra co-invest than to necessarily work with a competitor. And so over time, we found that we were being approached by some of our big GP relationships to co-invest with them. And as a result, we built a very interesting co-invest portfolio, but also, more importantly, a co-invest capability. And we built a team that was able to analyze individual deals, really evolving from having analyzed funds. And were able to make decisions quickly and deftly, and we were able to add slugs of co-investments into our existing GP mandates. That then evolved one step further, and we began to offer funds which were made purely out of co-invest. The final step on our co-investment journey was the ability to offer clients what we call opt-in or opt-out accounts. To bring this back to the family office space for a moment, there are many families out there who want to do direct private equity investments, They want to do them co-investing with a large and established and sophisticated partner. And they want to have the option to choose which deals they're doing and not to invest purely in a blind pool. And so for families who have the appropriate size of assets to do it, because it's not a small undertaking, we are able to build an offering that allows them to say yes or no to individual deals and build a portfolio that way. And also to, in some cases, really identify particular sectors that they wish to invest in, or, Simon, particular sectors that they don't wish to invest in, perhaps ones which their operating business is already in and they feel overexposed to. So the penultimate part of the private equity offering is secondaries. We brought in a secondaries team from Goldman Sachs, a brilliant team. COVID has made me very much lose track of time, but I would say it was probably about 4 years ago now that they joined us, and they've just been fantastic, and we've successfully raised funds for them. And I think your listeners and you will certainly know that secondaries are a very, very interesting addition to a private equity portfolio, particularly in order to shorten the J curve and to add diversification, sometimes at a very interesting value point. And the final element to our private equity offering is away from the private equity partners business and is our direct franchise. And that franchise has a dedicated focus on long-termism and a real vision for evolving the traditional PE model that we see today, which lends itself to family-owned businesses. And the way I would characterize that is twofold. First of all, family offices, as we all know, are often planning for the generations ahead. They're not necessarily planning for next month or next year. They're thinking about their children, their grandchildren, and maybe even their great-grandchildren. And so when you have that long-term focus, it often means you have the ability to take the duration risk, let's call it an equity, to invest in effectively permanent capital investments. The second part of this, that for me is incredibly exciting from a family office perspective, is that if as a private equity business, you are dedicated to long-termism and permanent investments, it means that family-owned businesses end up being an extremely interesting investment proposition. And those family-owned businesses themselves often have a preference for this type of capital. And the way to think about that is that if you have built a family operating business, maybe in one generation, maybe in 2 generations, and you have decided to take a large amount of investment into it, you are potentially relinquishing your control stake, or maybe you're even selling the entire business. Would you prefer to sell that business to an investor who may hold for 7 to 10 years, maybe doing cost cutting and restructuring, and then will sell the business on? Or would you prefer to sell to someone who's likely to apply less leverage to it and actually is intending on holding it for a significant period of time, growing and holding it for a significant period of time? And I think the answer is that the principals of the family offices and family operating businesses that we speak to are obviously incredibly successful business people. But there is an emotional attachment to a family-owned business that is very different from, quite frankly, my emotional attachment to BlackRock. It's a different thing. And as a result, we have several family-owned businesses that we've invested in, and I can really understand and see why that's the case, and I think is a very exciting opportunity for us going forward.
It's very clear. Thank you. So the other piece on the investment chessboard is hedge funds. And I hear all sorts of things, from those who have given up to those who espouse them, to the comment that perhaps worries me a little bit, which is that the part of the portfolio that acts as a fixed income replacement, and that worries me because of exposures, leverage, fees, net. Just tell me how you think about it.
Well, Simon, I think I might disappoint you a little bit.
Surely not.
Yeah, let's talk about hedge funds for a moment. So we have really seen over the last year or two a renaissance in hedge funds. There were many clients' families who were burnt during the financial crisis and who have been disappointed by hedge funds over the years, let's put it that way. And I feel my experience in my past role gave me some real firsthand serious conversations around this. But I think that hedge funds may be back. And let me give an interesting stat on that. So we did a family office survey around a year ago now, but things don't move that quickly in this world. And so in that survey, we surveyed 185 families around the globe, and we talked to them about lots of different topics. We interviewed them as well. And 38% of family offices in that survey intended to increase their hedge fund allocations because they were looking for uncorrelated return streams in the expectation of sustained heightened market volatility. Now, we have certainly seen an increase in hedge fund investments across our business, and we are seeing a difference in the way that families are looking to use hedge funds in their portfolios. So I 100% understand your concern that the idea of a long-short equity fund replacing a fixed income allocation in a portfolio probably doesn't sound like the most sensible idea. But I don't think they're thinking about replacing their fixed income allocation with a long-short equity fund. There are many, many, many strategies out there today that have been built specifically to massively reduce volatility and to deliver fixed income-like returns from a decade ago rather than fixed income-like returns today. Families, like all investors, are struggling with what to do with their fixed income portfolios. We talk at BlackRock a lot, and I'm sure we will do later in this conversation, around opportunities in tips to help deal with the spectre and actual reality of inflation. We talk about China bonds being a great opportunity to get some return from fixed income. But there are two other places that families are looking. The first is hedge funds, UCITS funds, carefully constructed to provide more of a fixed income-like return. And the other is actually private credit and direct lending. And I was amazed the other day to hear that one of our large family office clients in Europe is actually moving their entire fixed income allocation into private credit opportunities. So all of this is coming from an inability to get returns from fixed income, particularly in euros. I know I mentioned earlier most of our families are dollar denominated, but there are many across continental Europe who are still in euros, and the need to find an alternative.
So the asset class that rather surprisingly comes up less than I would expect in the conversations we have on the Money Maze podcast is real estate. Perhaps that is in part a function that it represents a core to many very wealthy families. But I'd like to know how that conversation goes with a family about real estate and the considerations.
I think you're absolutely right. So if you are a very wealthy family, you will absolutely have large real estate exposures in your personal residential portfolio and a likelihood of having commercial real estate exposure also. So it is always an interesting conversation. I think there's virtually no family that we've been to that has said, no, we don't own a building. But the part of the conversation where it becomes interesting is most families who have real estate exposure tend to have it in their home market. They can visit the building. It's easier to manage that way. They know their co-investors well if there are any. And their direct exposure tends to be in their home country or close by. So the more interesting conversations for us around real estate tend to be to talk to families about how they can expand their already successful real estate portfolio into other parts of the world. And so for European families, that obviously means US real estate. More recently, and for me, a little bit more excitingly, it's meant Asia real estate. And we have actually quite a large number of EMEA family offices who have invested in Asia real estate via our investment team and proposition. And the reason why that is because it's a long way away. The markets across Asia are unbelievably different from one another. If you think about investing in China versus Australia versus Japan, the structures of these markets are just diametrically opposed in many cases. And obviously the complexities of investing far away and not having boots on the ground are and sometimes insurmountable. But we do have those boots on the ground, and we do have those many, many years of experience and success in investing in those markets. And many of our European families have decided to come along with us for that journey, both investing directly into pooled vehicles, but also co-investing alongside us, in particular real estate opportunities so far in Australia and a current one in Singapore that we're looking at.
So you've mentioned Chinese debt. You've now talked about Asian real estate. I note from looking through some of the BlackRock Institute research papers, the role, I think I quote you, the potential role Chinese assets can play in strategic portfolios. And I just think it'd be interesting to talk about those legs, debt, currency, equity in China, and more broadly, because an observation I make is that for many in the West, the Asian component of their portfolio still looks quite small.
Yes, I would agree on that. So most family offices are underallocated to China. There's no doubt about it. In our survey that I mentioned earlier, 85% of families responded that they viewed a China allocation as distinct from the rest of Asia. So let's just focus on China for a second. So we believe that China provides a compelling portfolio diversification opportunity. Its growth is rapid, and that growth is one of the most important shifts in the global economy. It's the second largest economy in the world and is on a trajectory to rival the US, with currently $15 trillion of GDP versus $20 trillion of GDP in the US, and real GDP growth at almost 10%. So we can do the maths. It's not far away. Now, as family offices continue to seek growth and to seek income, we believe that they must consider an allocation to Chinese equities and also to Chinese bonds. We think that the market is impossible to ignore, and our capital market assumptions across almost any medium to long-term time frame shows the Chinese market outperforming all other public equity markets. So from a strategic perspective, we just think you can't ignore it. Now, let's be realistic. It's a volatile market, and there are going to be lots of bumps in the road. We're all aware that the recent regulatory clampdowns in tutoring and in tech unnerved global investors for a few months, and we saw some volatility. But that's why the risk premium for investing in China is higher than most developed markets. But overall, the volatility of the Chinese markets has reduced over the last 20 years and is much less correlated than other equity markets. Chinese bonds also provide diversification benefits. Again, they mostly move independently of other developed market bonds. And as I mentioned earlier in our hedge fund conversation, we see appetite in Chinese fixed income as potentially a substitute for traditional developed market exposure. So today, Chinese investment grade is yielding more than 5% in US dollar terms, and that is higher than US high yield is giving us today. So we think that the risk of not having exposure to China in the portfolio is greater than the risk of having exposure to China in the portfolio over the longer term.
So I'd like to talk about the ESG and sustainability issue. You made a point to me when we talked ahead of this conversation that it was actually a number of the family offices, and especially some of the families in the Middle East, that had started to discuss ESG and sustainability some time ago. And I'd just like to hear more about that.
Yeah, it's a very topical question. And as you know, something that BlackRock is out on the front foot about in the market. So sustainability and ESG investing, lots of different words used to describe an amorphous range of different techniques of measuring sustainability in a portfolio, is still a very heavily bifurcated landscape for family offices. So the interesting thing in the family office market is that families aren't necessarily under the same level of scrutiny from customers or other stakeholders that potentially a pension fund or a private bank or an insurance company is. And so basically, they can do what they want. If they want to invest sustainably, they can. And if they don't want to, there are very few people who are going to put them under an enormous amount of pressure or scrutiny in order to do so, if it's in their private portfolio. And so I think on that basis, the trends are really interesting because they're sort of independent of what's going on with other types of clients. I think there was an expectation when we started to talk about sustainability that family offices would be the first clients to change their portfolios. That hasn't been the case. What I would say is that if a family has a foundation, then the foundation portfolio has tended to go first, which absolutely makes sense because there's a desire to align the investment portfolio of the foundation with the impact that the philanthropic giving is having. So that completely makes sense. Family offices themselves have joined the party a little later. Now, this is a huge generalization because, as you can imagine, family offices in the Nordics and the Netherlands have had a focus on sustainability, ESG, impact investing for a longer period of time, as have all investors in those markets. They've been followed by continental Europe and the UK. Now, our survey told us that 80% of family offices are now engaging in some form of sustainable investment. And I think that we all have to remember that, though I've made this broad statement around no stakeholder pressure, values and legacy matter a great deal to families. And actually, I would say that the real stakeholders there are the next generation in those families. So that's where the pressure is coming from. And, Simon, I mentioned to you in our briefing a tiny little anecdote, but it's an interesting one, where I visited a family office and the principal is possibly in their 60s and has printed out the presentation we're about to give. And his daughter, who's in her early 30s or late 20s, has the presentation on her iPad, and a small family dispute ensues around the unnecessary printing of paper. It's a silly little anecdote, but I think it really is illustrative of the kind of sensitivities and concerns of the next generation, and the fact that actually financial returns are incredibly important, but having a social return or a climate return or an impact which is broader meets the purpose of the family has become more essential over time.
So I'm not sure how to feel, whether I feel ashamed or proud, because my notes for today's conversation are here on my PC, but I also have a paper copy in case my computer failed me. Where does that leave me? You referred to, and I want to talk about Aladdin, because Aladdin was first featured in a conversation we had with Martin Slenderbrook, chairman of Robeco, who had been a long-time servant of BlackRock.
My old boss.
My old boss.
Who, a lovely man.
He first mentioned that Aladdin was, should we say, the toolbox, which has allowed you to do a lot of great analytics. I think it was Mike Bloomberg who I heard once say about data, if you can't model it, you can't manage it. And I think you've had some clients, even billionaires, turn up with all their wealth on an Excel spreadsheet. Tell me a little bit about that conversation and what it is that Aladdin allows you to do.
Yeah, so Aladdin is effectively the technology operating platform that the whole of BlackRock has run off. And I think sometimes that's forgotten in articles that are written about it and when we talk about it. So it's the whole back-to-back system. And it's what our portfolio managers in every single asset class use every single day to manage the risks in their portfolios. They are able to price risk. They are able to understand intended and unintended risks that are being taken in their portfolios. And this is all done by the incredible sophistication of Aladdin. Now, the genius of this firm and its founders was that when they created Aladdin as this proprietary bit of technology, they realized that there was an opportunity to also sell Aladdin externally to third parties and to actually turn technology from a cost line into an income line. And that's a very unusual thing for a financial services organization. And because it's an income stream for us, it allows us to continually invest and reinvest and make it better. And probably around 4 years ago, we bought a business called eFront, which effectively is a risk management and operating platform specifically for private markets investments. And we have now included this in the Aladdin platform. So to move back to how we offer this to third parties and specifically how we can work with family offices using Aladdin, there are a few different options. And as you say, Simon, and it was interesting in the way you asked the question that it might be surprising that a billionaire has their entire portfolio run off a spreadsheet. I would say that the vast majority of our clients are running their portfolios off a spreadsheet. I would say that less than 50% of them have a sophisticated risk management system that they're using. And that is a little bit of a concern to me. So what can we do to help is a good question. The first one is that we are able to use Aladdin to do risk analyses of client portfolios. It's not something that we charge a fee for. It is something where we're happy to sign an NDA and we will take in a client portfolio and we will analyze it up and down, left and right, inside out. We will analyze that portfolio. And on the back of that, we will have what is often a very powerful conversation with the client around the risks that they're taking. Now, if you put yourself in a position of a family office where perhaps you've got a few different asset managers running mandates for you and you've got investments in multiple vintages of private equity funds, actually it's very, very complex to really understand and manage the risk in that type of portfolio. So being able to provide them with those types of insights can be invaluable. And there are two types of outcomes to those meetings. The first one, which is the boring one, but one could argue is the best, is that the client learns absolutely nothing because they are fully aware of all the risks that they're taking, and we have not uncovered anything that they didn't intend to take or didn't already know. And so for the client, maybe in some ways that feels like a less of a value-add conversation, but actually, perhaps ultimately it's a reassuring one for them. The other outcome is that we're able to show clients that they are taking factor investments they didn't intend to. We are able to stress test the portfolio to show them what will happen to it in the event of a financial crisis, of the event of an interest rate spike, in the event of an oil price spike, and hundreds of different scenarios that we can run. And maybe they will find that their portfolio is not performing in the way that they wanted. And especially given what we now know well, which is that most clients are looking for capital preservation plus growth, sometimes those risks can look alarming. And what we really then try and do is to help the client think about their asset allocation and how perhaps it can be tweaked to provide them with a more resilient portfolio across different types of market environments. So that's the first and the most everyday way that we're using Aladdin with family office clients today. Almost every client we meet, if we see a significant need for it during our conversations with them, we will offer them what we call a BPAS analysis, our portfolio analytics service analysis and consultation. The interactions then can become more structured and more formal and more contracted because, as I mentioned, we do sell Aladdin and eFront to third parties. My experience in EMEA has been that eFront, the private markets part of that system, is the thing which is most needed and most appealing to family offices. And so we have a number of families across the region who have now bought eFront and are no longer having to do capital commitments, capital calls, portfolio analysis across multiple vintages on their spreadsheet. And I think that the people who are most relieved, delighted, and thrilled to be on the receiving end of this system tend to be the CIO and the portfolio analysts who've been having to do that work manually up until then. It's a huge time saver and hugely additive.
My observation working with a few family offices is that they underestimate just how much in the way of resource has to be committed at an operational level for consolidation analysis, risk management, etc. From where you sit, Sheryl, what would be your expectation of how the family office structure and landscape will change over the coming years?
I think there's a few different ways that family offices themselves are going to evolve as we move forward. The first is a continuation of an existing trend that we see, which is that families are becoming more sophisticated and more institutional in the way that they're run. And partly this comes down to a growing number of very large families. We all read in the news that the rich are getting richer. Multiple surveys tell us the wealth market is growing at 4 or 5% a year, and that the family office market is growing at 9 or 10% a year. So we can see the families themselves are getting bigger and there are more of them. And as a result, they're becoming more sophisticated and more institutionalized. What does that mean? So the first thing that it means is that we are seeing an increased appetite for alternatives. Families already bought a lot of alternative assets, but we expect that to continue. And while in the past that's been predominantly private equity, we would expect it to continue to be private equity. However, we're seeing already a desire for a more diversified alts portfolio. So we're seeing increased interest in private credit, direct lending, infrastructure, far away real estate, and just more niche and specialist offerings. So that's the first outcome, I would say. The second is around sustainability. We've already mentioned your stakeholders for this are the next generation. So the expectation is absolutely that sustainability and ESG will continue to grow in families' portfolios and across all countries. Our hope and expectation is that everyone will be where the Nordics is. And finally, the role of technology. And this is the case, obviously, across all industries, not just the asset management industry. But there's no doubt that our clients, and families are no exception, want to have a more convenient experience when they deal with us, in the same way that you and I want a convenient experience when we're ordering our taxi or our Deliveroo. And so my belief is that we, as an industry, will need to meet them with more convenient ways for families to interact with us, for them to receive their reporting, for them to understand their risk analyses, and to really interface with us as an organization. So that would be really the third element of my expectations.
And we're sitting on the cusp of this massive, I believe, unprecedented intergenerational wealth transfer. How are you processing that as you deal with these family offices?
Yeah, unprecedented, certainly once in a generation. I think we're doing it in a number of ways. The first is that we recognize that it is actually essential for us to build relationships with the next generation. There are many pieces of evidence that allude to when wealth is passed to the next generation, that next generation doesn't tend to stick with the advisors necessarily that their parents had. And so in an evolving world and with these trends, it's really important for us to build not just the offering that meets the needs of the next generation, but also to build our relationships with them. And so we're doing that in a number of ways through our everyday activities. But one thing that we're really focused on is education. So BlackRock has something called BEA, the BlackRock Education Academy. They used to always be in person, and then obviously we switched to virtual over lockdown, and now we offer a combined virtual and or in-person experience. So 3-day forums, they take place all over the world, and each one is focused on a different asset management or market topic, be it asset allocation or alternatives investing or investing sustainably. And These sessions are aimed at not just family offices, they're aimed at institutions as well and some wealth management clients. But where we think that these can be most valuable to our family office clients is for the next generation, because they are purely educational sessions that teach people around how to manage portfolios, how to understand risk in portfolios. And we think that that's the most valuable thing that we can provide for the next gen.
Thank you. So I'm going to ask you two final questions, short questions. I'd like short answers. Number one, how would you describe the culture here at BlackRock?
How do I answer that quickly, Simon? Now, listen, given I've worked nowhere else, I can't really compare it to anywhere else. But what I would say to you is that the culture here is incredibly collaborative. So it is one P&L. We don't have competing organizations within the business. It's not territorial in that type of way. Very, very, very collaborative. I mentioned earlier, absolutely at the forefront of our mind at all times is our fiduciary responsibility. And I would use the example of when we do year-end reviews, we have to give real examples of how we've acted as a fiduciary to our clients over the course of that year. So it's not a bunch of words on a website or on a screensaver. It's a real thing. And collaboration and fiduciary responsibility, I would say, sum up the culture here.
For a loquacious person, I think that was relatively concise.
Thank you.
And secondly, although these family offices are very different beasts, what would be the one piece of advice you would offer these investors that reflects the typical challenge and dilemma that you have most frequently encountered?
So I think my advice would be for those families to think really carefully about what the goals are that they have for their portfolio, and to be realistic around how achievable those are. And once they are set, to stick to them so that they can build a strategic asset allocation and build a portfolio that will truly meet those goals over the medium to long term while providing resilience to the portfolio.
Great. Well, Sheryl, thank you so much. This has been a conversation which I have not just enjoyed but learnt a lot. Too much to summarize, actually, but there are two things that I'm particularly going to take away from this. One is that there is an absolute secular trend of the institutionalization of the family office, which goes hand in hand with sophistication, and that goes from maybe not using your Excel spreadsheet to entertaining more complex and at times less liquid assets if constructed in the right proportion, and assuming that you're clear about the knowledge of your objectives. And number two, that family offices, notwithstanding all of that, have more often than not the overriding goal, which is sometimes forgotten, of the need to conserve capital in real terms, because typically for many of these organizations, my experience has been that they create that fortune once and that their advisor's job is not to try and help them recreate it with the attendant risks.
I think that's a fantastic summation, Simon, and thank you for making this a very enjoyable conversation today.